Retail inflation rose to 4.62% early this month and is expected to inch upwards. While for the policymakers who are looking to cut policy rates to boost investments, this presents a challenge as it would only add to inflationary pressures. Investors too need to worry as inflation can eat into the investment returns. I am Deepthi Bhaskaran, and today on Why Not Mint Money, we will understand how inflation impacts your investments and why it's important to ensure you earn a real rate of return. A very simplistic definition of inflation would be that it erodes the value of money. So retail inflation at 4.62% means that what you can buy with say 100 rupees today will become expensive and cost you 104.62 rupees next year. This means the value of 100 rupees has eroded because you can no longer buy what you could earlier with the same money. On top of that, when you consider the fact that inflationary pressures compound over time, it could lead to some serious erosion of value over the long term. So as an example, let's say you buy a bag of chips for 30 rupees today, and let's assume the long-term inflation is at 5%. So while next year the same bag of chips will cost you 31 rupees and 50 paise, over a 15-year period, the cost of the same bag of chips would more than double to about 62 rupees. As an investor, you should be mindful of the fact that your investment portfolio needs to stay ahead of inflation because otherwise your capital is actually losing value. So in order to protect your investments against inflation, it's important your investments get a real rate of return. Real rate of return is the return on your investments after you factor in inflation and other costs such as taxes. It's important for your investments to make real return if you want your wealth to grow. Think of it like this. Over a 15-year period, your money should grow to an extent that you can comfortably buy that bag of chips and you have some money left. That's what long-term investments should do, especially when it comes to your retirement nest egg. And this is why when you invest for the long term, asset allocation that's in sync with your time horizon of your financial goals becomes very important. It's absolutely essential for you to resist the urge to invest in long-term guaranteed products as they are ineffective in battling inflation. Let's take an example of a fixed deposit of a 10-year fixed deposit scheme. Currently, the rate of interest on a 10-year FD ranges between 6.25% and 6.75%. Let's assume you invest in a fixed deposit with a rate of 6.75%. Interest income from fixed deposit is taxable, and so if your marginal rate of taxation is 31.2%, your effective return from your investment would drop to 4.64%. And given that long-term inflation for the purposes of financial planning is pegged at 6%, the value of your money has actually degrown. Even if you consider the current rate of inflation of 4.62%, the real return is marginal. Inflation can be a silent killer for your financial life, and the best way to battle inflation is to have the right asset allocation. Chalk out your goals and invest accordingly. So while for the short-term goal, safety of capital becomes priority and therefore guaranteed products are viable options, for the long term, your portfolio needs to beat inflation, and equity investment is the perfect solution. The best way to invest in this asset class is through mutual funds. Even gold is a good hedge against inflation, but it's advisable to not allocate more than 15% of your money to gold. Of course, how much exposure you take to equities and further in what category do you put your money in will depend on your risk appetite. Consult a financial planner for your financial health and breathe easy. Hope you enjoyed the video today. Thank you and have a good day.